Hello traders, and welcome to part 2 on my Elliot wave theory trading series. Today we'll be talking about ratios, alternations, and Fibonacci extensions within waves. And if you haven't seen my video, part 1, or my videos on Fibonacci trading, I'd recommend that you check those videos out before we start, because today is going to be a lot of Fibonacci retracements. So without further ado, let's first jump into ratios and alternations. And this might sound complicated, ratios, extensions, but it's really not. Just as long as you know the math and what's likely to happen, you can find really good spots where to buy and where to sell as well. So now let's jump into ratios. When you have a breakout with high volume, as you can see right here after a downtrend, what you're usually looking for is not to buy immediately, because then you get this, you get hit with a very large loss. Instead, you want to wait for wave 2. And if you might be wondering this is wave 1, where do I buy wave 2? Usually, wave 2 goes down to the 61.8% level. Sometimes it also goes down to the 50%, but it's one of these two retracement levels that'll probably be hit. And the reason this is because many traders who still believe that the market is in a downtrend sell price down to the level of 61.8 before it really can't go much lower without it turning into a continued downtrend. And a good place to spot a wave 2 is when you have really high volume, low tails, bullish engulfing candles, and then put a buy order at the 61.8 if these things are happening, and then you'll probably be able to catch a pretty big uptrend. So this is wave 2. And then if we look at wave 3, wave 4, usually what will happen, if wave 1 retraces 61.8%, then wave 4 will probably retrace just 38.2 or fail to go down to the level. As you can see here, it almost retraced 38.2%. And the reason that is because of alternation. And alternation dictates that wave 2 and wave 4 will alternate in how much they retrace. So what that means is with a really sharp, heavy correction like this one right here, you're probably going to get a much more minor, more sideways correction on the next correction in this Elliot wave theory sequence. And the reason that is twofold. One, that one of the rules of Elliot wave theory is that wave 4 in a zigzag, which I'm talking about, a zigzag is the 5-3 pattern, is that wave 4 cannot go into wave 1 territory. So as you can see here, this is wave 1 territory right up to this high, and wave 4 stopped right above this territory right here, and then continue to go upward. And as you can see here, if you had put a buy order, around this level, you would have had a very nice profit for wave 5. So that's alternation. We've gone over wave 2 and wave 4 retracements as well. Now I'm going to talk about something just a little bit more complicated, but really not that hard to understand, which is where to sell instead of where to buy that we've been talking about. Now, where to sell, there are a lot of good spots to sell, but it matters what wave you're in and what wave is extended. And what I mean by that is that in a 5-wave sequence where 1, 2, 3, 4, 5, usually one of the waves, like wave 1, wave 3, or wave 5, will extend. And almost always the wave that extends is going to be wave 3. And the reason that is because the middle of an uptrend is where the uptrend is strongest. And the reason that is because many investors and traders can note that price is going to continue going upward. So you get a lot of new buyers coming in and not really too many sellers. And that's why wave 3 is usually the strongest. When you see that wave 3 is extended, and what that means is that wave 3 is longer than wave 1 by a good amount too, which it is here. As you can see, the low of wave 3 is 176 and the high was 320, which is a very solid gain right here. And this one only went up 131 from 132 up to 263. And when wave 3 is extended, and this is really important, wave 1 will usually equal wave 5. I'm going to write that down. Wave 1 and wave 5 will usually be equal in magnitude if wave 3 has extended. And we can see that actually on the chart right here. This goes up 131, and then from down here up to here, this goes up 129, which is just about the same level of increase from the low of 271 up to around 400. That's where price went. Wave 1 was equal to wave 5 here. Now, how can you use this in your trading if you're confused or if this is just some, jumble? Well, if you were in this spot right here and you were a good Elliott wave theory trader, you would notice that this was clearly 1, 2, 3, and you had a bit of a sideways correction here. You still believe that price will go up. Well, you can note a few things. You can note first that wave 3 has extended, and then you're getting a minor correction here that's more sideways. You have some support up here that might be hit, and you know that wave 1 will usually equal wave 5. So what you could do is just put out a sell order that is about 131 above 271. And then if you had done that, then you probably would have gotten filled right here and reached the actual absolute maximum profit you could have reached on wave 5. So that's the ratios between 1 and 5 when wave 3 is extended. Now, if wave 1 was extended instead, that what you would probably see if wave 1 was quite powerful, then usually wave 3 is only going to be 61.8% of the magnitude of wave 1. And basically what that means is that let's say wave 1 goes up $100, then wave 3 will probably just go up around 62 because that's around 61.8%. And then wave 5 will probably equal wave 3, as two waves in Elliott wave theory, 1, 3, 5 usually are equal, and usually the extended wave is not equal to another wave. If any part of that is confusing or you don't understand, just feel free to leave a comment about any part of it that you really don't understand. And the last thing I'm going to talk about is the Fibonacci extension tool. So if you were way back here and you saw wave 1, you saw wave 2, and you were looking for a place to sell for wave 3 after you had bought, and you're looking for a profit target, what you could do here is draw a Fibonacci extension. So what you're going to do here is you're just going to outline wave 2, as you can see here, and just sell at the 161.8 level. And if you had done that and sold at 317, then again you would have reached a maximum profit right here, because price went up to 320, and that would have been a brilliant sell if you had noticed in the market, okay, wave 2 retraced 61.8, we have great volume here, this looks quite bullish, the trend line was broken, and I'm looking for a place to buy and a place to sell. You would buy around here at that 61.8, and then you just sell at around 317 for that extension here, as you can see. And then if you had noticed that, and then sold here, and then bought back in here at the 38.2% retracement, and would have known that 1 is usually equal to 5 when wave 3 is extended, then you would have sold here too. That is 2020 hindsight, and I know that's not fair to think that way, because any trader can trade really well with 2020 hindsight, but these rules do apply really to any market, just because of the cyclical nature of how people trade and how people operate in the markets. And Fibonacci retracements do work a lot of the time. And when I'm looking back at a lot of data, I can see that what almost always happens with larger time frames is that it's those Fibonacci retracements that are really important, and that's where price usually stops and turns the other way. So today we've gone over, to recap, we've gone over Fibonacci ratios, we've gone over alternation, wave 2 and wave 4 alternating, we've gone over Fibonacci extensions, as you can see here, predicting this price point, and also how when wave 3 is extended, 1 and 5 are usually going to be equal in magnitude. And that's going to be it for today. Again, this has been a lot of material that's probably quite complicated, so if you guys don't understand any, just leave a comment. And thanks for watching.